One of the highest compliments I ever received from an investor was during this global financial crisis. There's a youngster about 35 years. He may be 35 years, but he's extremely risk averse. After I advised him, he put his money into a mutual fund. I don't want to name the fund. 4 lakh rupees was invested on the 8th of January 2008, the most inauspicious date, because on that day the market closed at 20,873. Put another way, there is no worse date you could have invested. But when you follow this kind of a strategy, the money has not been put into the stock market. It has been put into one of these funds, liquid, short-term floating or short-term fund. It's a debt fund. 1% was transferred, 4,000 a month was transferred. Sometime in May or June of 2009, he came to me very worried and he said, everybody is talking about how the stock market has collapsed. I'm very worried about my investments. Now in May or June, the market had already started going up. I said, sit down. I'm not going to show you your position today. I have a software which will give me your position on the 9th of March 2009. Understand this, investment made on 8th of January 2008. We are looking at 9th March 2009. Why this auspicious date of 9th March 2009? Because on that day, the index was at its all-time low of 8,168 points. Understand this, 20,873 is what he started this zero risk STP. We are now reviewing on 8,168. Do you know the value of his 4 lakh rupees? On that day, it was 4,20,000 rupees. 4,20,000 rupees. Because regular STPs were taking place as the market was coming down. He had also bought a number of units at very good prices, but the bulk of the money was in debt. Debt was earning something. If you ask me about return, it's a pathetic return, maybe 3%, 3.5% over 15 months. But this guy gets 3.5% when other people had lost their pants. When 100 rupees had become 40 rupees. You can control risk. Let nobody tell you that you cannot control risk. You can control risk. And it does not end here. And the compliment I was telling you about that this investor gave, he kept on scratching his chin and staring at the screen. He again and again asked me, do you mean to say that if I cash my investment today, I'm going to get 4,20,000 plus 20,000? I said, yes. Then he once again scratches his chin and looks at me and asks, then what is this global financial crisis that everybody is talking about? You can control risk. The strategy does not end there. You want to make it even better. The STP can be doubled or quadrupled when the market falls by more than 25% or 50% from its previous peak. If you do this, your returns will be far, far higher. We keep on blindly parroting this, higher the risk, higher the return. This is one strategy by which, without taking risk, you can get a very good return. I believe in questioning everything. I will not take somebody just parroting something. That's why if I have put something on my presentation, those things have been questioned and found to be correct. That's why they are on the screen here. This is something you should never forget. The first rule of investment is do not lose. And the second rule is do not forget the first rule. And that's all the rules there are. The people who follow that systematic transfer plan strategy, if you think it's very boring and very slow, remember one thing, Warren Buffett is with you. Warren Buffett is with you. When you talk about lump sum investments in equity and equity mutual funds, they must preferably be with a margin of safety. I have come here today. If I can leave you with these 3 ideas, my work will have been very well accomplished. First idea is systematic investment is good for you. But if you do not want any risk, systematic transfer plans can work for you very well. And the third idea is, I would like to address this thing called the margin of safety, most important for equity investors. You have heard of this timing the market. And suddenly somebody will say, all the good writers will tell you, do not time the market. Do not time the market. I don't agree. You can time the market. But my timing of the market would be a little different from what most other people talk about. There are 2 approaches to this timing the market concept. And it's fascinating because both these approaches come from investing giants. The first giant is John Templeton. What he says is the time to invest in stocks is when you have the money. History shows that time and not timing is key to investment success. A brilliant, he says, when you have the money, you invest. Don't worry about whether it's 20,000 or 30,000 or 5,000. You remain there long, you will get the returns. And he is correct. Let's look at this. The return ranges for rolling periods on any day from 3rd April 2079 to 28th February 2007. Almost a 28-year period, BSE Sensex. Let me explain what this is. If you are the worst investor in India in the BSE Sensex, that is always buying it at the peak, the worst 1-year return you would get is minus 54%. You would have lost half your money. The best return you would get if you are the lucky chap who bought it right at the bottom in this entire 29 years, that too rolling returns, you would have almost, your money would have been more than 2.5 times. If you stretch the time horizon, you can see how the risk comes down. For 2 years, the worst thing that could have happened to you was minus 26 plus 143. As you increase the time horizon, you will find risk disappearing. Remember the definition of the time horizon. A time element attached to each avenue of investment, which if adhered to, eliminates risk. Look at this. And delivers optimum return. 25 years, if you had bought at the worst possible date in 25 years, but you had waited for 25 years in the Sensex, you are getting 15% compounded annualized growth rate, money doubling every 5 years. That is what 15% CAGR is. So John Templeton is absolutely not right. He is a fellow who says, forget timing. Forget timing. He is absolutely correct. So one small thing that I have to point out to you is, because I prefer the other option. I'm not saying this is wrong, but I prefer the other option of Benjamin Graham called the margin of safety. Over 25 years, there's a huge difference between even 1% in return in the ultimate corpus. So certainly Templeton is not wrong, but you can perhaps try this as a normal individual investor. Benjamin Graham's the margin of safety. What is the margin of safety? Margin of safety is the difference between the intrinsic value of a stock and its market price. That Benjamin Graham is the father of value investing. Benjamin Graham may be the father of value investing, but we may not be able to or have the resources or the education to do our own value investing. It's sometimes a little difficult to arrive at these calculations of intrinsic value. Sometimes the calculations can be wrong. So what would be my interpretation of the margin of safety? To make it simple for something everybody can follow, my margin of safety is very, very simple. Ensure that you do not pay too high a price for stocks. Try to get some discount. Now, how do you do this? First step, be aware of the price-earning ratio ranges of the market. The PE ratio ranges are much more reliable than simple high and low in the market. Historically, if you see in India, the price-earning ratios of the popular indices like your BSE 30 or NSE 50 have ranged between 10 on the lower side, 30 on the higher side. And these figures are easily available on the websites of the BSE or the NSE. Second, be aware of the market highs and lows, and not just the market highs and lows, the percentage of high to low falls, very important. Let me quickly refresh your memory. During the Harshad Mehta scam, on the 22nd of April 1992, we had this index figure, and it fell to a low of 2037. In percentage terms, the fall was minus 54%.